Good morning from here on the U.S. East Coast. Very early good morning for a couple folks on the U.S. West Coast, and good evening from India, and good afternoon for those in Europe as well. My name is Josh Hollander. I'm the CEO of Horton International North America and co-founder of the InsurTech Association, along with my colleague Bob Sargent. I'll be your moderator today. Jumpstart USA is a joint program between the InsurTech Association and the India InsurTech Association. So thanks to those folks for their support in putting this together. And also thank you for the sponsorship from Metro Hartford Alliance and the CTIFS, also known as the Connecticut Insurance and Financial Services Group. As I mentioned, this session will run about 60 minutes. We'll have a market overview, a moderated panel, and then the Q&A at the end. And again, feel free to drop your questions into the chat anytime. The session is being recorded and we will share materials afterward. So first, let me hand it over to Bob and Rahul Nawab from the Indian InsurTech Association to kind of set the stage and provide a little background on the organizations involved today. Bob?
Sounds great. Josh, you want me to share slides or
you can do it if you got it handy, or I can, either way.
I do. Great. See that? We're good?
Yeah, we're good.
Thank you, Josh, and thanks everyone for joining us. I'm Bob Sargent, founder of eSpecialty Insurance in the U.S. So to start a little background on ITA, ITA is a nonprofit association. We're focused on innovation in insurance, and we're open to anyone focusing on supporting InsurTech innovators. So we provide a range of benefits, including networking, both in person and virtually, not only connecting with other insurance innovators, also connecting with capacity providers, vendors, investors, and industry leaders. We also have educational opportunities of various types, such as this webinar, and a number of initiatives, including things like the regulation of AI in insurance in the US. We have a wide range of members. ITA is particularly valuable for founders of InsurTech companies at any stage, but we're open to anyone with an interest in InsurTech, including traditional participants in the industry, such as brokers and insurance companies. We also have members that are vendors, consultants, community groups, press, including experts. Sponsorship has been critical to our progress. These are our current sponsors, including our founding sponsors. We definitely want to thank our sponsors for directly supporting a range of activities, and this group has made the startup of the association possible. And we're always looking for additional sponsors. There are a range of benefits to being a sponsor beyond just supporting the InsurTech community, including visibility, access, and hosting opportunities. We would appreciate your consideration of sponsorship. Please let us know if we can support innovation in insurance in any additional way or different way than we're doing it now. For those of you who have not joined yet, we hope at the appropriate time you might join. And thank you for those who are already a member.
Do you want to mention the InsurTech Growth Network for just 1 second?
Sure. We have started putting together an angel investing group for early stage InsurTech entities in the U.S. That's getting going. We have about 20 members at the moment, and we are open to providing access to investors of various types for those raising capital in the U.S.
Okay, great, thanks.
Great, thank you. Thank you, Josh.
Rahul, take it away. I think you're still muted there. Blue button on the bottom. Oop.
There we go. Can you guys?
Yes.
Yep. All right, great. Hey, thanks Josh and Bob. So we are really excited about this partnership that we have from an IA perspective with ITA. The India InsurTech Association is a not-for-profit organization in India, which brings together the Indian InsurTech startups with insurance companies, technology partners, players, service providers, and insurance professionals to help grow the ecosystem. I'll just go through a couple of pages here. So our mission is to facilitate partnerships between startups and the broader insurance industry, be an independent voice in the InsurTech ecosystem, help the InsurTech companies in India access the global markets. That's what we are here for. Publish and promote thought leadership. We have a lot of sort of thought leadership pieces getting published. We do a white paper with BCG on just the whole InsurTech ecosystem in India. We have thought leadership coming out on a weekly basis. And we want to connect InsurTech startups with insurance industry experts, not just within India, but across the world, right? So that's, again, this whole mission aligns really well with it, with what we're trying to say. And promote initiatives which use technology, in an creative way. Two more pages I want to go through. A lot of members, 230 plus members. A lot of activities to boost penetration. There is a BCG annual report that you can bring down. A lot of different working groups. There are a couple of ecosystem partners from an India perspective. When you think about insurance, there's a lot of things around actuaries, Insurance Academy, BIMTech, and now Gift City as well, right? So a lot of partners. We do a lot of thought leadership, like I said. There are a lot of virtual events, and happy to participate in any of these. There is an annual event that we just finished as well. And lastly, I want to talk about the international partners. ITA should be a part of this, but we have about 10 different international partners that we work with, that we have aligned with on all the actions that I talked about earlier. Lastly, this is the first 20% program that we are trying to launch in this ecosystem. How can we help facilitate Indian InsurTechs to go into the US, UK, MENA, and then other geographies? So I'll pause. Really looking forward to the conversation. Wanted to give a good overview of the InsurTech IIA Association.
Okay, great. Thanks, Rahul. All right, so just one more quick sponsor spotlight, and then we will jump into the agenda in more detail. Looks like we have a good crowd there. And again, as I mentioned before, feel free to introduce yourself in the chat, put your questions in the chat. This is intended to be an interactive session. So we're very appreciative of Metro Hartford Alliance and CTIFS as our sponsor for the Jumpstart USA series. So I'll turn it over to Gene Goddard to share a little bit more about those organizations. And Gene, I'll pull up the slides for you quickly here.
Thanks so much. Good morning, good afternoon, and good evening, wherever you are in the world today. Thanks for joining us. Again, my name is Gene Goddard. I'm the Chief Business Investment Officer for the Metro Hartford Alliance. We're a business development organization that helps InsurTech and FinTech companies enter the U.S. by choosing a safe landing spot in Hartford. As you're looking at the U.S., your possibilities are endless, but we believe that there's only one starting point, and that's here in Hartford. We have the ecosystem that you need to be successful as far as entire business community focused on insurance. We've been doing this for over 250 years. We are known as the insurance capital of the world, and we focus on helping companies make their marketplace here easier by having the ecosystem of a regulator and a business community, plus proximity to customers that you are looking to sell your product to. Connecticut, if you don't know where we're on the northeast corner of the United States, with Boston to the north and New York to the south. Between that 4-hour corridor is about 40% of the US's insurance industry is headquartered there. So the people that you need to talk to are within a short 2-hour drive of Hartford or in the city of Hartford itself. Next slide, please. One of the things that we've done to help U.S. or U.S. companies and U.K. companies expand and grow quickly is by creating an InsurTech quarter with the British government. So far, over 12 companies from the UK have announced that they're going to put their US headquarters in the Hartford region to help make that more successful. This project also supports other companies like yours in India. We help you by meeting the market, by introductions through there, research, incentives, labor force data, helping you get connected to our legal and accounting community, those people that really understand the insurance industry that help you be more successful. Next slide. So please feel free to reach out to myself and Susan Winkler on my team that oversees our insurance financial services efforts, and look forward to meeting with you in person, either in New York or Las Vegas or somewhere else.
Great. Thanks a lot, Gene. And again, we appreciate your support, not only on this program, but for some of the other events and things where you've been very supportive. And I happen to be based in the community. It's a great ecosystem here, and the team at Metro Hartford Alliance and CTFS is very supportive. Bob, can I flip it back over to you just to give a little bit of overview of how this is a program, and this is the first session of several for the Jumpstart USA program?
Sure. Thank you, Josh. So as I mentioned in the introduction, we have a number of initiatives. For example, we have initiative and a partnership on the regulation of AI in the insurance industry in the U.S. Jumpstart USA is another initiative. We are starting to bring participants from around the globe who are interested in the U.S. market more access and resources in being successful in entering the U.S. market.
All right, great. So one of the things I'll just add in there is that, again, in a 60-minute webinar, there's only so much content we can fit in today. So if there are topics that folks would like to see covered, I see someone mention like the health insurance ecosystem and health tech. Please let us know, and we can develop content around that in the future as we go forward. So I'm going to segue into a quick market overview. We are fortunate to have Brian Rafisi. He is a vice president at Marsh Berry, which is one of the leading advisory firms in the insurance distribution space, doing a lot of M&A transaction work and also providing other services to the insurance industry. So Brian, I know Marsh Berry's got tons of great data, and usually you've got lots of slides slicing and dicing the market. But, in the interest of time today, I think, we all know the U.S. is over $1 trillion market. And so just to kind of get back beyond that, maybe you could just start by giving us, your view of the current state picture. Where's capital flowing? What's happening in M&A? And, for purposes of this discussion, where are maybe some international entrants gaining traction?
Yeah, for sure. Thank you. Can you all hear me?
Yep, we're good.
Well, good morning, good afternoon, good evening. Very excited not just to be here on behalf of Marsh Berry, but with this amazing panel of esteemed colleagues. Yeah, you're absolutely correct. When we think about insurance, and maybe one of the places to start on a broader market overview relative to, it sounds like people that are not domiciled here in the United States, is the insurance marketplace in the United States is complex in that there's three main categories, which I think is much different than, let's say, India, where you probably have a life category and a general category. Here in the States, we think about it as health insurance, life insurance, and property casualty insurance. You're absolutely right, Josh. You mentioned $1 trillion market. When we think about that, that's on the property and casualty side. If you look at the total health market, we're probably about $1.5 trillion, in addition to the $1 trillion of P&C. And then we have another $1 trillion life market. So I think one of the things to talk about as we think about coming into the United States is just having a clear understanding across which one of those very different insurance marketplaces you should think about. That's part one. I think part two, relative to your question about capital inflows, specifically here in the United States and specifically around the distribution of property and casualty insurance. It's actually the number one asset class that's being rolled up from private equity investment today. So very interesting, just thinking about where investments coming through on the distribution side of property and casualty. And again, I can go talk about this for hours, but an important part about that I'll just loop back to is when you think about InsurTech spending, technology spending specifically in the insurance value chain, there's over $440 billion of just P&C spend and another $4 billion across InsurTech. And what's interesting about that $4 billion of InsurTech spending last year or investment last year in the US, a bulk of that actually went into the distribution channel. So there's a lot of investment. There's a lot of investment in technology across all three of those segments and specifically in distribution.
Great. So can we maybe segue, specifically? So let's just say hypothetically, maybe there's a company that's built a business, 5 million, 15 million revenue, still growing, relatively early stage, but, found product market fit and starting to scale. And maybe they want to start building in the US and raise some capital to do that and tap into the US capital market. Could you talk about maybe what US investors are looking for now, and has it changed at all over the last few years since maybe the peak of the InsurTech fundraising period?
Yeah, absolutely. Great question. I think it's interesting in that you look at InsurTech spending almost relative to what we're seeing across the broader market of technology, and that is there was a wave where growth definitely outpaced profitability, and there was a lot of initial startups in what I'd call kind of the class of 2017, 2018, or the InsurTech 1.0s that had a lot of promise and arguably didn't deliver on those investment thesis. And I think that byproduct of that was a lot of write-downs relative to investors and their expectations. But the flip side of that is the kind of next wave, the InsurTech 2.0s that really were able to achieve that funding and call it 2020, 2021. It's really interesting, and the ones that have actually survived that have built something that's really meaningful and were early adopters. It's interesting. I don't know if anybody saw it yesterday, or earlier last week, but the great insurance tech consolidation wave has arrived was actually an article published on Forbes. So really interesting article that was published last week, largely because it aligned with our view here at Marshberry about where that is. And in all the cases, our view and with this article that Forbes published, I believe doubles down on is it's always a build, buy, or partner type of conversation relative to the investment decision makers who are saying, hey, is there something already out there that's going to improve my profitability, bring me scale, bring me vertical integration across the marketplace? So that's not different. I'd say the one thing that probably is a little bit different as we think about 25 coming into 26 now is almost that focus on profitability. Again, just building something for the sake of building it was probably earlier that trend in 2020 and 2021, but building it with a means to an end, and that end ultimately being increased profitability, lower expense ratio, lower loss ratio on the insurance side is really, I think, top of mind for investors as well.
So thanks for that. That's very helpful. So the build, buy, and partner conversation is interesting. There was a period, I think a few years back, where some large incumbents did some mega deals where maybe it was almost as much about making a PR statement about we're innovative and looking ahead as anything else. There's still some larger transactions out there, but it does seem like there's another flavor, which is almost sort of like an acqui-hire, where maybe companies are looking to buy the talent as much as they're looking to buy the technology and do tuck-in deals versus mega deals. Is that a sign sort of that it's more about the technology and the people and trying to find a way to mitigate the risk of full acquisitions? Does that have any implications for an international company's eventual exit strategy? Any thoughts on that?
Yeah, and I don't actually want to steal the thunder of the panel that's coming after me, where I think we're going to get even deeper into why it makes sense to pair technology and culture with something that's actually meaningful and working. And I know we're actually going to talk a lot about that, I think, on the upcoming panel. because some interesting perspectives, I think, of people that have actually lived that journey. But yes, the answer, not just on the technology side, but if you're following just insurance generally, what we're seeing on the talent kind of shortage side is massive amounts of people coming in and taking teams from other people. And without going into detail about all the news, you can just start to Google what we're seeing across the board, and that's translating onto the technology side as well. Even within technology, I'd say hires relative to the ability to take a team, again, take something that's actually working and plug it into your culture and your current systems.
Okay. Just one last quick one, and I just want to stay on schedule. And anything in particular where you're seeing trends around where international companies are winning, any particular verticals, lines of business, where maybe there are some competitive advantages?
Not just for the sake of them being an international company. No, again, I think what we're seeing by and large are the companies that are successful in both raising funds with a solid business plan, then executing on the business plan, and then ultimately transacting at the exit multiple comes down to, good planning, good execution. And that's not necessarily international versus national, but again, just solid investment thesis relative to find the problem, make sure that you have competitive advantages around what you're building, and then actually executing on the plan.
All right, great. Well, thanks, Brian. I'm just looking through the questions here quickly, if there's anything we could hit quickly. I just want to say thanks, everyone, for the questions and the comments in the chat, and introducing yourself is very helpful. For some of the newer people who've joined, feel free to do that as well. I don't see anything specific at the moment, so I'm going to keep it moving here into the panel that Brian referenced. And Brian, thanks again so much for participating and sharing that information. Okay, so this section is our operator panel, and so we've got 3 high-level execs who have different perspectives on this, different stages, different scale of organizations, etc. And so first of all, I'd like to introduce Jonathan Jackson. He is the CEO of Provisico. It is a floodline risk intelligence company based in the UK. Jonathan is in the early phases of US market entry and brings the perspective of someone navigating it right now. Anurag Shah is the founder of Aureus Analytics, also known as Dana, which was acquired by SIAA. Anurag has lived the full journey, started out building a business in India, selling into the Indian insurance market, entering the US, and then exiting through acquisition. And Namit Chopra is at EXL, which is a large-scale enterprise with a deep US presence. Namit brings the perspective of scaling a major operation in the US market. So thanks, everyone, for joining. And again, in the interest of time, I'd like to jump straight into it. So, excuse me, Anurag, I'd like to direct this first question to you and specifically focus on your decision to enter the US in the first place. So you started out building Aureus in India and then made the call to cross over. And so, at that time, which was a few years back now, what specifically told you the US was the right move, and how did you choose your initial beachhead segment?
Thanks, Josh, and thanks everybody for inviting me. Appreciate the interesting conversation so far. So from my perspective, we started the business. The Aureus business was started in India. We started working mainly with life insurance companies in India. That was our starting point. Running a data analytics platform, expanded that a little bit into PNC, and eventually India is a pretty interesting market, as many people here would know. Like, it is a large market from a population standpoint, but from a number of carriers and number of insurance companies perspective, is still smaller. And as we wanted to expand, we had kind of started to reach a point where we had almost 60-70% of all the companies being our customers in India already. So we had to look at other places to expand. We explored a few other markets. Eventually, just the scale of the US market opportunity versus investment. I mean, we did explore Europe and some of those, and we did explore some of the Far East. But eventually, just from a scale of operations and return on the time invested, US made the most sense, and we participated in a couple of accelerators, one of them being in Hartford. But that basically was our journey, just to test out what makes sense. And I'll pause here for now.
Okay. And so I'm going to pivot over to Jonathan, because that was what, 2018 for you, Anurag, I think.
Yes.
So Jonathan, you're kind of in the early days with Provisico, and could you share a little bit about what your U.S. entry thesis looks like? Has anything surprised you about how different the go-to-market motion is here, either in terms of how people buy or how you need to price versus markets you've been in already?
Sure. Thanks, Stephen, for inviting me along as well. And great to have the opportunity to share a little bit of Provisico's story with everybody. So our sort of thesis coming into the US was to really test out whether what works in the UK would work in the US as well. But there was a sort of a pretty significant caveat to it, which is that we knew that the US, when it comes to flood insurance, is a very different market. So the UK flood insurance market effectively means everybody in the UK is insured for flood, and the insurer has to specifically tell you if you're not. In the US, most people don't realize they're not insured for flood, and so it's a very different world. So we kind of knew that, and our approach was to sort of look at it from the perspective of, we were working with some pretty significant insurers here in the UK, people like Zurich and Liberty, and therefore thinking, okay, well, let's see if we can actually make things work in the US as well, going down that route. We've also been very focused around the large commercial market. Our services adds the greatest value in that market, because effectively, as you mentioned in the intro there, Joshua, we're providing flood warnings. So if you've got 1,000 assets which are geographically spread out in a region, you are going to have flood risk. There's no doubt about it, which is very different if you just got 3 or 4 manufacturing sites. Very different situation. So for us, we were looking at specific sort of market segments where we've had success here in the UK to test that out. And the other thing that was kind of interesting for us as well is we actually did have an insurer who specifically asked us to come into the US. And actually that was quite key to us. We felt that if, when you've got a customer asking you to do that, it sort of gives you more incentive to do so. So those are the sort of real drivers for us. And kind of been testing that thesis out, as you said.
Just a quick follow-up question. Was that customer that asked you to enter the market the main partner to help you kind of think through the differences, or did you rely on other resources to really try?
No, it is an insurer, but they are quite a unique insurer. Without sort of, if I why they're different, everybody will know who it is. So to not to reveal confidences, just have to leave it at that, I'm afraid.
Okay. Excuse me, Namit. So EXL is a much larger organization, so it's a different kind of equation. As you entered the market and maybe as you continue to grow, sort of what frameworks or criteria you use to decide where to invest in U.S. growth, and how have you sequenced it?
No, thanks so much, Josh, for having me on the discussion. And it's great to meet everyone: Brian, Jean, Jonathan, Robert, and Rag. So I think we've had at EXL, we've had more like an interesting journey. We started back in '99, and we started as a typical BPO organization, kind of primarily working on the services framework, supporting clients with, lack of a better word, body shopping in terms of lower labor cost available in India. We made the pivot to more of a data and AI solutions company. It's about almost a decade now or more than that. And that's where we've been kind of supporting clients. Brian, to your point, PNC, LNA, and health, we play in all of those specific business segments within insurance. There has been a dramatic shift in the market in terms of what insurers are expecting us to do. It's the era of services, I can probably safely say that's probably gone. Everyone is kind of looking for the right value-added services or products or solutions, which again, Brian, I referenced what you said, profitability is number one for everyone right now. Revenue growth or premium growth is something which a lot of insurers have given up to get more profitable customers onto their side. So from our side, we've kind of invested quite a bit on the agentic and the Gen AI side, first to help insurers in the underwriting space. How do they kind of get the most profitable and the customer who's likely to stay for the longest onto their books? And for that, you probably have certain segments like commercial and specialty and MGAs, which are ripe for growth right now. Personal lines, I think it's kind of at a saturation point right now with a lot of competitors who are kind of going against the same customer. But we've deliberately kind of focused on specific segments in the market, which is kind of on the commercial and the specialty line side, and really zoomed in on areas like underwriting and claims, specifically underwriting, which kind of drives attracting the right profitable customer to our clients' books. So that's where a lot of our solutions are currently focused on in terms of making underwriting efficient, best in class with maybe third-party data or leveraging Gen AI. And that's kind of resonating well for us in the market as we've kind of evolved our overall business model.
So, Namit, I'd like to maybe pass you one of the questions from the audience, just given the scale and the different verticals that you do play in. What are the main areas of InsurTech collaborations that you foresee at this point, either currently in 2026 or maybe moving forward?
Sure. For InsurTech collaborations, one of the things we are kind of seeing a rapid increase is, again, I keep coming back to the underwriting and the pricing side, but a lot of carriers, just given the profitability concerns, are getting to more areas in dynamic pricing, looking at innovative ways of underwriting, and also cost management with more automated claims adjusting or claim handling per se, right? Similarly, customer experience, which more often than not is more like a differentiator for a lot of insurance clients. Think about some of the large ones and the small ones as well. Really transforming the entire customer journey is another focus area for a lot of InsurTechs we kind of run into and in some ways compete as well. So I'd say underwriting, pricing, claims, customer experience in that order, those seem to be ripe for disruption in what we've seen in the market. Okay,
great. Thank you. Anurag, I'm going to kind of start with you on this one because you and I have had a couple of conversations about this previously. But, pricing and buying behavior in the U.S. and the way the U.S. market actually buys is something that I think catches a lot of companies off guard. And so, what was your experience like in terms of the buying process specifically compared to India? And so, everything from the length of the sales cycle, who's involved in making the decision, how pricing expectations compared to the Indian market, negotiation style, et cetera.
Yeah, no, that's a pretty interesting question and kind of covers most of the journey that we've had as well, right? So definitely one learning I would say we assumed coming into the US is whatever products we've built and the way we deliver in India would replicate as is or pretty much close to as is to the US market. And that was definitely not true. Right from pricing to regulation. Sales cycle is interesting. Not that sales cycles in India are shorter, but it does depend on who you are selling to. So if it is enterprise sales, selling to large carriers, sales cycles are long in both parts of the world. So that's probably not too different. The way they are long is probably unique. In an India sales cycle, you probably see a lot more negotiation and back and forth, and in a US sales cycle, it may be a little bit more bureaucratic process than negotiation process. So, but again, both have long sales cycles if it is enterprise. If it is not enterprise, that's a very different story, and that does depend on what consumer segment you are going after. But our experience has been mostly enterprise. From our perspective, we also pivoted a little bit from enterprise. So initially, when we started working with some of the large carriers, and definitely was a challenge in terms of sales cycle. We got introduced to a very interesting concept of working with, and I say interesting because anybody coming from India probably doesn't have that perspective of working with independent agents and brokers, which is not very common in the Indian ecosystem. And that actually gave us a lot of success. So I think from an Indian ecosystem perspective, that might be a completely new area, which is a big opportunity. And again, Brian mentioned some of it as well. The distribution side is definitely where that plays, and that really is a massive opportunity with a at least comparatively shorter sales cycle.
So just a follow-up point on that. I'm not sure if we have anyone on who's an expert more on the group benefits side, but one of the questions is, what's a reliable channel to reach out on the group benefits side? Anyone have thoughts on that or want to take that one?
Yeah, I can take it. Because group benefits is interesting. And when you think about insurance in the US, and for those of you who might already know this, it might be repetitive, but we have 50 different state regulators in the US. So we actually have 50 different kind of climates relative to how insurance is written. And in the employee benefits side, it actually is considered more of a P&C and group life and benefits chassis than it is on the healthcare side, which makes it even more kind of dynamic compared to the individual insurance side. So like the entire conversation around group and group benefits is pretty complex. And then to put the overlay on that, and it varies by 50 different state regulators. So there's probably a lot to unpack there, but it is an interesting segment for sure. And it's here. What was the specific question? I can't see the questions.
Oh, sorry. So it's a company that does have a few partners here, but wants to, scale to a large number of, voluntary group benefits brokers or agencies. And so, what's the fastest way to go from 5 to 100 relationships, to scale that up?
Yeah, again, great question. I think, the other interesting part about the group benefits side is they're not always just individual group benefits on the distribution channel agency. So there's a lot of times the group benefits is also combined with the P&C agency. So we are seeing some tech investment in employee benefits, though. I think there's a lot of people trying to solve the U.S. healthcare problem. And one of the other components of group benefits, by definition, it's a group chassis, which has to do with the filing at the regulatory environment, which is different than an individual life or health product. I'm sorry. So yeah, it gets complex, but to scale, it's not an easy. I'm going to point to these top 500 brokers because they all only sell employee benefits.
Yeah, and I probably should have clarified, Brian. It's a solution for helping speed the enrollment process. Is that in this case is being marketed. So trying to get.
We can definitely take it offline. I'm available on LinkedIn as well, and happy to reach out and have even a more detailed conversation on it.
Great, fantastic. So, Jonathan, I think you're enterprise focused as well, and so any further comments relative to what Anurag said? Sort of enterprise is enterprise, or have you found it any different here in the U.S. versus your prior experience?
So yeah, I mean it's actually pretty similar for us when it comes to enterprises and flood. I guess the thing that we've really sort of started to talk to now is to help organizations understand flood risk better. So whether you're UK, US, there's typically a bit of an education gap with a lot of large organizations. The exception tends to be utilities. They are pretty good, and also big transportation hubs. So, for instance, we work with the company called Network Rail, who runs the UK's now rail infrastructure. They really get flood and understand the risk. And then similarly, we're also talking with the MTA. Again, they really understand it. So you do have these pockets of people who really get the risk, but for the most part, I'd say there's a real education gap when it comes to flood. Insurance has done a great job in helping organizations understand fire risk. And really, they need to do the same with flood. I mean, it's quite interesting to see how under factored flood risk is when it comes to organizations. They typically say, okay, well, this site flooded 5 years ago, and that's all that they focus on. They don't actually try to really evaluate the change that is happening when it comes to flooding. And so, there's a lot of confusion also caused by FEMA flood maps, because the FEMA flood maps are really helpful at telling you about flood risk, but people believe if they're not in a FEMA 100-year flood risk, then they're fine, which clearly isn't the case. So yeah, well, that's really our big challenge that we face when it comes to organizations, but it's the same for both the UK and the US.
Yeah. Maybe trying to stay on time. We're a little behind here. I want to save some time for the Q&A, but another question from the group. What is the normal sales cycle time? Anyone want to?
Finding is the answer.
Get that one? Raul, I see you laughing. You want to dive in on that one?
I think everybody knows the answer. It's just who you know, not the sales cycle. But it could. The insurance companies here are getting more and more regulated, and I mean, all the purchasing organizations are also getting involved, and it's tougher and tougher. So give yourself enough time to start. But once you have one and it does well, I think it is a very small industry when it comes down to it. So good references matter a lot, just like anything else. Getting from 1 to 2, 2 to 5 is difficult, but 5 to 50, not as tough, I think.
So I'll just.
I'll probably just add one more.
Yeah, go ahead, Nate.
I'll just probably add one more thing. I know insurance sales can be a little nerve-wracking in terms of you kind of perpetually wait for the customer to respond, but things have started to change, and I think as new players in the market, there should be an appetite for investment into, say, what they call as a proof of value, to actually showcase how your product and solution can drive the right business outcomes. If you go with an open mind and with some investment appetite into an insurance organization, things can change fast. But as everyone was laughing, it's still a painstakingly slow sales cycle time for a lot of clients we work with.
Namit, I'd like to ask you one more question that frankly will probably be an entire hour session down the road in this Jumpstart program, but maybe you could just give a quick thought on regulatory and compliance, because I know an organization at EXL's scale has to think about that every day. Would you have any suggestion for a company just entering, kind of what the minimum sort of compliance infrastructure they need to have, and kind of how they need to think about the regulatory structure here in the U.S. with the 50 state regulators, et cetera?
Sure. Yeah, you're right, Joseph. It's probably a 1 hour discussion, but I'll kind of
maybe a 10-hour discussion.
Yeah, but I'll give a short gist. So I think the insurance industry is unique because a lot of the information which kind of gets captured at insurance companies is unstructured. And that's where, think about medical bills, police reports, even legal bills and forms and underwriting submissions and so on. The biggest thing to keep in mind is how do you handle PII for a lot of life and PNC clients, but also PHI for some of the health insurance clients. And what we've, of course, we have our own pre-built solutions, but data masking and data obfuscation to kind of really look at desensitizing some of that information. So for example, if I want to run a Gen AI chatbot on your voice transcripts with your customer contact center, really masking out all of the PII, PHI is critical before you even start to discuss any of the solutions or outcomes which you might deliver as part of that. Now, there are specific state regulations, California, which might have things related to how you handle personal information. There are states which are coming up with their own AI laws, which kind of dictate how does your AI system handle bias and fairness. But long story short, just make sure you're working with the right masked data as you're kind of working with insurance clients. And as you work across different states, make sure you kind of work with the right set of regulatory lens, be it states like California, which tend to be really penalizing in terms of how you use different technologies, or some of the others like New York and Washington, which are kind of very sensitive to how personal data is kind of handled. So that's a quick 2 cents on this, but happy to have that conversation in a follow-up session.
Great. Thanks a lot, Namit. So just one last question for each of you before we wrap up the panel and move fully into the Q&A. So like 30 seconds or less, and Raul, you can feel free to chime in on this one as well. If you could go back to day one of your US market entry and give yourself one piece of advice, what would it be? Anyone? Anurag, you want to start us off?
Yeah, sure. No, absolutely. And I'll split this into 2 parts quickly. One is going back to this sales cycle piece. It's an industry that is averse to risk. So anything that you can present in your sales cycle that diminishes risk reduces the sales cycle, and that we kind of learned over time. So the way you present your solution with the lowest risk to the buyer helps reduce. It doesn't eliminate it, obviously, but it reduces the sales cycle pressures.
All right, great. Thanks, Anurag. Jonathan?
Yeah, I guess one of the things that I would say that I would do differently is probably be more focused. We've looked at a number of different areas. We've kind of come in and looked at the market and tried to see where the hotspots are for flood, as opposed to actually just saying, okay, let's just target this one area. Even though it may not be the biggest area, the fact is just really target that and see what we can do in that one particular space. So that would be the thing I think that would be good. I guess often it's referred to sort of, you having a beachhead. And for us, I think a beachhead in the US could have either been a sector. So for instance, we do a lot of work in the construction sector, because it suffers an awful lot of flood. So we could have potentially targeted that. I think another way we could have looked at it is actually looking at it from as opposed to looking across brokers, both large and small, similarly carriers large and small, we could have potentially just decided to pick a certain area. Even captives actually is another one we've been looking at. So just really focusing on one of those and really testing that out properly. I think it's something that going back I would have probably done.
Yeah. Okay, great. Good advice. Namit?
Yeah, I think one of the things which sorry, there's some feedback. Yeah.
Okay, we can hear you okay.
Great. See, insurance is a unique business. I've spent about 2 decades in insurance, far less than what a lot of folks here have. But as you kind of approach new clients, it's really important to understand first the domain instead, in terms of how the product works. How does claims work, for example? Because it's very different from any other part of the world. We like to call it that every state is a country in itself within the US, the 50 countries within the US. So it's really important to kind of talk their language, understand their product, understand their regulatory landscape. And that goes a long way in terms of ensuring that you actually kind of win with some of your pursuits. So that's a good lesson learned over the past 2 decades. Just do your research, understand the products, the line of businesses, the states a company operates in, and talk their language. That's key as you kind of enter into the market.
Okay, great. Rahul, give you the last word.
I think, in summary, I agree with what everybody said. It is a complex market. It is one of the most analytical markets, and folks are very on both sides of the equation. When you're selling and when you're buying, and being extremely thorough with what you're trying to say always helps, because the folks on the other side, the buyers, are very, very savvy about what they're trying to get into. So that is the one thing that I learned over the years, that be very thorough with what you're saying. Otherwise, you can be found out very quickly.
All right, great, fantastic. So we do have some questions in the chat, and so that's the end of the formal kind of portion of the session. And feel free to add additional questions in the chat. We'll go through them here. I will just say, again, we intend to have multiple sessions digging into some of the topics we've talked about today in more detail, as well as others. So we'll be running sessions every couple of months going forward. If there are any topics you'd like us to see cover in those sessions, or separately in office hours or other things like that, in between, or just publish content on, please let us know, and we'll work to incorporate those into the Jumpstart program. Excuse me. Let me just scan through. Bob, if you saw any questions you thought were interesting in there, feel free to dive in as well. Let's see here. Well, going back to the health insurance, one of the questions is, any particular areas in health insurance tech at the enterprise level that anyone sees gaining traction? Anyone want to take that one? Any thoughts? No?
I mean, I'll jump in there only to say health insurance in the U.S. is really complicated because it's a private marketplace, but there's a huge influence of the federal government with Medicare and Medicaid dictating prices. So, look, the U.S. has a lot of problems relative to how to deliver affordable health insurance at the individual level, and then technology definitely is slow adoption rates compared to other industries. So. It's definitely not my area of expertise specifically, but there's a big $1 trillion marketplace out there that needs some dire help.
Yeah, and I think from what we've seen as part of the organization, fraud is one of the biggest areas which kind of comes up in any health insurance claims conversation per se. So fraud, waste, and abuse, that seems almost like a no-brainer for a lot of companies trying to enter the space.
Yeah, I think in some solutions around behavioral health and trying to change outcomes for members in who are old for employers, and then try to by improving health and outcomes and reduce costs for employers. And I think there's some technology elements to that in terms of the monitoring data, education, and how that gets communicated out to employees as well. Okay, let's see what else we have. Well, we've kind of covered this a little bit, but maybe if anyone has any thoughts, any common mistakes you've seen or would particularly try to avoid entering the U.S. market? We've heard a couple.
Maybe I can take this one. I mean, I would say having a physical presence and having somebody here local makes a big difference. And this is probably more with a relevance of a mid-size early scale. Somebody is a large company might be different. But if you're early stage, people need to see you and know you before they get to do business. Insurance is a large industry, but it's pretty orthodox and conservative in some parts. So they do need to see you and know you. So I think having a presence definitely is critical.
And just to add on that, actually, I'd say that I completely agree with Anurag. So be prepared. It is not cheap to recruit in the US, and also you've got to be very careful about assuming that it's a similar sort of employment rules, etc., that you have in the home country as compared to the US as well. So make sure you really understand that sort of side of things. And then something in addition that I would throw out there, which I think is that we've seen benefit of, and we've really had huge support from the InsurTech corridor, which is in relation to things like accelerators. I think accelerator programs have been really helpful for us in the US. So I would sort of say that's a great way to start to get yourself into the market in a really quite organized way. There's a number of insurance accelerator programs, and also in certain verticals as well. You'll be able to find those programs too.
Can I maybe ask a quick follow-up question on the accelerators and incubators? What any thoughts on what realistic expectations should be for those? In terms of what are you actually going to get out of it in terms of helping to shape your go-to-market or your product market fit? And then also, I know for a fact that there isn't sort of customers ready to sign POCs or contracts at the end of accelerators, but what would you say are realistic expectations for a program like that?
The first accelerator program we went into in the US was Plug and Play down in Silicon Valley, and they actually have an InsurTech stream, and that was just great for helping us understand who was really interested in the whole flood space. You get to meet a lot of innovation teams, and for us, sort of going through the innovation side was a pretty sensible route for us to go. So we certainly saw value in that. And then the other thing too is typically these accelerator programs will have a lot of investors there as well. So investors tend to use it as a way to filter out opportunities. So that would be the other thing that I would say for somebody coming into the market, in a first accelerator. And then some of the vertical accelerators, we've been part of a vertical accelerator in the construction industry by a company called CRH, and that actually did produce a commitment to doing a trial with us, which was a paid for trial. So those are out there. We've just recently been in, or still actually are in a thing called the Transit Tech Lab, where we are doing going to a year-long trial with the Port Authority of New York and New Jersey and the MTA. So I'd say that you can get some really tangible business outcomes from these.
Actually, you brought up something interesting, Jonathan, that I do want to mention, because I'm not, particularly in India, I'm not as familiar as to whether the concept of an innovation team versus, dealing directly with heads of lines of business and things like that. Anyone have any thoughts on kind of the evolution of innovation teams, and is that still a good entry point, or how would you approach them? Because I know some of them, you have had sandboxes, but they haven't necessarily always been fully connected to the problems for the people running P&Ls within the organizations, and sometimes there's been a little bit of a disconnect there. Anyone have thoughts on that for those who are thinking about entering the U.S. market?
Maybe I can take this one briefly. I would say that the role of innovation teams has somewhat changed over time. Back in 2018, when we started, there were pretty much everybody had an innovation team, and they were running these different pilots and trying to test out different technologies. I think they've kind of slowed that down a little bit, going back into the businesses actually owning it, because we realize that the innovation team might be excited, but the business team that actually funds it may not have any interest or in putting things in production. So I think over time that has evolved a little bit and has gone back to the business owners, which I think is good overall. So that makes sense. And every accelerator, we've been part of Plug and Play and the one in Hartford as well. So I think every accelerator will have a different flavor of who they give you introductions to, but really understanding the market and getting introductions is the best outcome from these accelerators.
I got another question from the audience here. And by the way, it is a little past 8:30, so I want to thank all of our panelists, our sponsors, our partner in IAA, Raul, for participating. For those who have to run, feel free to drop off. I can stay on, and anyone else who can stay on to answer questions for a few more minutes, that'd be great. But one question here is from an InsurTech focused on, it looks like commercial P&C and working on solving efficiency and accuracy around data ingestion and risk assessment. Anyone open to commenting on kind of what the market is like for these type of process automations in the US, and where might someone focused on commercial P&C start? Any thoughts, Namit?
Yeah, sure. So I think as you're kind of looking at some of the commercial lines, workers' comp, general liability, commercial auto, a lot of the underwriting processes or workflows, as we call it, think underwriting right from submission to quote to bind to issuance. There are a lot of manual handoffs across different parts of the process. And that's where these are kind of ripe for automation in some shape or form. So a lot of times, for example, rating a particular policy according to your rate plan, traditionally done manually, but a lot of insurers are now automating that process end to end. One of the things we are doing for a client is kind of also reimagining the entire underwriting workflow, right from submission. How do you digitally extract information, then automatically pass it to a predicted model to say whether it aligns with your underwriting appetite. And then a slew of agents kind of come in, which kind of do work related to rating, endorsements, coverage, verification, and then finally pass it on to issuance or bind if you decide to kind of go ahead and bind that policy. So the first step in any such process or a workflow is doing some sort of process mapping or process intelligence exercise to capture the current state, understand your different touch points or handoffs, and identifying opportunities for automation and AI. So what we usually do is a diagnostic to kind of understand the current state of the workflow, identify opportunities for automation and AI, and then plug and play our accelerators on top of that. So really, it's about understanding what workflow you're solving for, underwriting claims. It could be any other operation within the organization, say billing and collection, mapping out the current state, looking at the existing data to get insights into the process, and then kind of putting in your accelerators or solutions which might be out there. I think for the commercial lines, I would say all of the lines of business are kind of ripe for disruption, because a lot of times insurers are still stuck in their legacy platforms, multiple underwriting systems, multiple handoffs, as I said. So yeah, that's a quick answer to that particular question, Josh, if that helps.
Yeah, great. Anyone else have any other comments? I think I've gotten to the questions. Just double checking. Well, maybe this is one I missed. What opportunities exist in the U.S. on the corporate insurance side for a new age insurance broker? Not exactly sure what that means, but any thoughts? Raul, have any thoughts? Brian, you have any thoughts? No?
Well, I'm not sure about new age insurance broker. I think, look, to sum up, I think a lot of the conversation we've been having, the P&C marketplace, the health marketplace, and to some extent the life marketplace in insurance in the U.S. is fragmented. It needs technology. We're lagging kind of compared to other segments and industries across the board. And then you just made a great point about just like individual risks and the pooling risk concept and how technology is going to change that when you think about how to underwrite. And Jonathan with flood and understanding like the FEMA maps and what that actually means for individual risks, the way that we've never thought about it before. So if I could close with a comment relative to P&C insurance, commercial insurance, and then specifically new age and whatever that means. And my last thought on that is we're ripe and we're an industry that's kind of ready to change, but we're also very slow to change. So it's kind of balancing that as we go forward with, you know, the language as you're thinking about how to make an impact and what the greatest impact you can make is. Those are my closing thoughts.
Okay.
Hey, Josh, can I add to that?
Yeah, sure. Go ahead.
So I think it's a really interesting question because I agree 100% with what Brian just said in terms of the need for technology and distribution. But Nimit made a comment early in the discussion about understanding the product and everything around it. And I think the implicit part of that is don't make assumptions on how things work. And I think one of the challenges, so two comments on this question. First of all, technology will change the business. I think the question is how we get there. And I think people often forget that distribution in the property, at least the property casualty segment of the insurance business in the US, has a function. And people that are executing that function are resistant to change if that change is going to impact how effective they are at their job. So I'm a firm believer that technology will change distribution, but the disruptive approach, I think, is going to be very hard to make work. There have been some really technology-focused distributors, startups recently that have had a hard time. So it's not as easy, I think, as some people might think to execute. I'll stop there. I'm happy to talk to anybody about this. I spent a lot of time on this.
Yeah. So we do have two other questions that I didn't see before. One's a little bit more macro, but I think it's a good one. What's the best way to complement and not replace existing internal solutions when approaching insurance organizations as an InsurTech? Anyone?
Yeah, I can't offer a lot on that because we don't replace anything, so I'm not really in a good position to comment.
Yeah, maybe I'll try it. And we talked about it, and Mitt, I think you mentioned it too. One of the other, I won't say mistakes, but understanding the U.S. insurance market, and especially on the P&C side, it's $1 trillion marketplace. But when you really start to boil that down, there are lots and lots of individual classes of risk. So to say, like, how do we replace something that's already there? You know, figuring out a better way to mitigate risk. And look, at the end of the day, and Jonathan, I'd love your thoughts on this relative to flood. And that is, you know, we have natural disasters and we have, you know, risk that needs to be protected. So you're not really replacing that concept. What we're doing now is we're thinking about the segments relative to easier to identify risks and how to price that compared to more complex risks and how to price that. So it's, to that point, we're not really changing anything. We still need to protect risk and find the right financial outcomes relative to protecting the risk that we're talking about.
Yeah, I couldn't agree more, Brian. I mean, that's, you know, kind of when I was drawing the analogy earlier between fire and flood, is that there's been a lot of investment in terms of how to manage fire as a risk. It's pretty much every risk engineer out there, the first thing on their list when they go and see a client is looking at fire risk. So that's such a huge area, and clearly where we see a great opportunity, but it's also, as I said, that's the learning curve we're trying to take people up as well.
Bob, just curious if you'd be open to take this one. Do you see any AI first distributors coming along in the USA? And if so, which product line might be best suited?
I'm not sure I yet understand what an AI first distributor is. Is AI being used in distribution? Absolutely. I think people are trying to figure out what that means. As I was saying, distributors generally are open to new technology. They may not want to pay for it like insurance companies do, but they're open to it. But something that disrupts their functional approach or disrupts their relationship with customers is going to have a hard time. And at the end of the day, distributors are sales organizations. That's their job. And so how an AI first distributor might look, I think, is an open question today. So I'm not familiar with anybody who is purely AI operating today. I don't know if Brian, if you've run into anybody like that. I haven't. But we are using AI extensively. And I think it's sort of a mixed bag in terms of how distributors might be open to using AI and how it might impact their operations, particularly negatively.
Yeah, I think, and for those of you who it's easy enough to go find kind of the news articles a few weeks ago in Insurify, which is a kind of US domicile digital platform for personal auto insurance, announced that they were the first kind of web-enabled distribution channel to be ChatGPT available in native AI, and it actually tanked the U.S. stock market relative to the S&P index that follows P&C insurers, because there's that fear that's coming out there. But we're sitting in 2026 and we're just now getting to the point where that news is hitting the marketplace. So I couldn't agree more, Bob. It feels like it's taking a while to get there. And again, I can't stress this enough. It's different by every one of these classes. The easier to place, easier to identify risk in our world is personal auto. It's also the biggest risk class that we have. So that's probably the easiest one. When you get to, Bob, some of the stuff you're writing, highly specialized risks that need to be identified, that gets a little bit more tricky on how easy that is to kind of quote, find and issue that policy.
Yeah, I mean, I think what it gets down to is that at the end of the day, here's an example. When I was saying that, is AI helpful or disruptive to that particular sales organization? The sales organization is responsible for getting it right. So a 90% correct answer does not cut it. And right now, one thing I didn't say is the AI we're using, we always have a human in the loop 100% of the time, because it just doesn't get it right 100% of the time. And so I think, we will get there. I don't know if we're going to get there with AI in 6 months or 6 years. It's moving so fast, we'll get there. The trick is for everybody in distribution, how you figure out something that impacts positively profitability and does the right job for the customer and the sales team.
So we do have a couple more questions, but we've run about 15 minutes over, and I'm sensitive to everyone's time. So I want to thank, our partner in the India InsurTech Association. I want to thank our sponsor and Metro Hartford Alliance and CTIFS. I want to thank the speakers for coming on and sharing their insights. And I want to thank all of our attendees for joining us and your interactivity during the discussion. As Bob said, you can feel free to reach out to any of us Bob, I don't know if you have the slide with the links there handy, but you can certainly feel free to reach out to any of us through the InsurTech Association website, InsurTech Association, no E in there, .org, or our email info@insurtechassociation.org. I'll just put it in the chat real quick.
Yeah, I don't have the slides up anymore, Josh. Sorry.
So you can check out our website, or
Similarly with IIA as well, right? So yeah, I think this is
and certainly, Raul, if you want to put any info in the link in the chat there for people to connect, can do that. But certainly, can reach out directly to the IIA folks as well. And if you have questions, if you have suggestions for topics to cover in future sessions, please let us know. And thanks so much to everybody.
thanks.
Thank you very much.